Yesterday, both the euro and the British pound entered a strong downward correction fueled by US labor market statistics. Data showed that US initial jobless claims fell last week, touching the lowest level in 2 months. This indicates that the labor market remains strong, which allows the Federal Reserve to keep monetary policy tight for longer to combat still substantial inflation risks. Against this background, the risky assets slid, retreating from overbought territory. However, their downside potential is likely to be limited, as today's macroeconomic calendar is bereft of any crucial news releases. In the long term, given that July is expected to be the last time the Fed raises interest rates, the greenback will likely remain under pressure, with the euro and the pound sterling resuming gains. Before we get into technical analysis, let's consider fundamental factors. Traders may take notice of data on UK retail sales. Downbeat statistics may put more pressure on the British pound, resulting in increased short selling activity. The lack of important statistics covering the Eurozone economy will probably allow bears to drag the assets down to weekly lows. But then they are likely to give in to bulls, thus enabling the risky currencies to recoup recent losses. According to the 1-hour euro-American dollar chart, I think the best way to make profit is to buy the euro at around 1.1109 after the price hits a new weekly low. A false breakout at this mark will create a buy signal, thus driving the euro up to 1.1164. If the price fails to break above this level, it will most likely bounce back to 1.1130 and 1.1109. Alternatively, if the price overcomes 1.1164 and tests it from the top down, the volume of long positions will increase further, with the euro rising to 1.1215. At this level, I recommend going short on a rebound, counting on an intraday correction of 30-35 pips. In case of a dip below 1.1109, Europe's single currency will probably edge lower to 1.1059. At this mark, it would be a wise decision to go long on a rebound to catch an intraday correction of 30-35 pips. Speaking of the British pound, the situation is similar. Bulls are likely to take the lead at around 1.2852. A false breakout at this mark will create a buy signal, pushing sterling up to 1.2904. If the price breaks through this level and tests it from the top down, another strong buy signal will be generated. Thus, the British currency will have every chance of recovering to 1.2960. At this mark, traders are recommended to go short on a rebound, trying to catch an intraday correction of 30-35 pips. As an alternative, a false breakout at 1.2904 will lead to a decline to 1.2852. In case bulls fail to regain control of the market at this level, sterling will extend losses, heading for 1.2803 and 1.2754. At these marks, it will be possible to open long positions on a rebound. Good luck and have a nice weekend.